Hmm. Let's start. Krishna. Let's move to modification. Move to modification of the forward contracts. Let's put down. We are moving to modification of the forward contract. Modification of the forward contract. Generally, we used to have questions on the cancellation side. So the questions which have been coming on the late is early delivery also. It could be cancellation, due date cancellation, before due date cancellation, after due date cancellation, or automatic cancellation which will arise. Then we have early delivery. It could be exporter or importer case, the request for settlement of early, in which swap points will come. I'll start with the normal due date cancellation first, just to give you a hint how the due date cancellation will work out. Let's put down due date cancellation. This will help me in making my framework a due date cancellation. This will help me in making my framework. Let me, if I have something. Will take help of this data. So we'll have a due date cancellation. In due date cancellation, I'm taking up an importer's case. In the case of an importer, let's suppose he has $1 lakh to buy. The original contract in this case was to buy $1 at 65. I'm just assuming rough numbers from my side. And the cancellation happens after 3 months time. 3 months was a due date. Now, since the original contract was buy, he will have to buy. The cancellation will be done by sell. That's the reverse way. Dollar agreed rate at which was decided in the zero period, that is called agreed rate, will sell at, since it is happening on a due date, the sell will take place at a spot rate. That's basically the cancellation due date. Spot rate is rate of the 3 months time period. So if the original agreement was buy, it has to be bought, and the cancellation would be by sell contract. Now let's suppose on that date I'm assumed some numbers. Let's suppose spot rate after 3 months, there are two spot rates possible. There could be a 60 or a 70. If the rate is 60, buy dollars at 65, which was this rate, then sell dollars at 60. Buy dollars at 65, and if 70, sell at 70. In this case, we'll have, first case will be loss, which will be borne by the customer. Second case is the profit, which will go to the customer, because the buying happens at 65. This was an agreed rate. Selling will happen at a spot rate. In original, if I look at the importer's contract, that's basically, you should remember two things. Original contract will happen at a ask rate. Cancellation would take place at a bid rate. cancellation would take place at a bid rate. This should not confuse you. Importer is never applied a bid rate, but for the purpose of cancellation, he would be applied a bid rate which comes out. So the things to remember from here is original contract was to buy, he will have to buy. If the cancellation is happening due date, then whatever is the rate on that date, based on that date, cancellation will take place. For the purpose of cancellation, it's for the purpose of cancellation, importer would be applied bid rate. That's the cancellation. Exporter case, original contract is to buy. Exporter would have done the agreement to buy, due to some reason he exporter would have done the contract to sell, due to some reason he is not able to fulfill this contract. It's a due date cancellation. Original contract, I am assuming, was 3 months time. If it was 3 months time, in this scenario he will have to sell. Sell would be cancelled with buy. That's the contract. So sell at agreed rate, buy at a spot rate on due date cancellation. Original contract of the exporter is bid rate, and cancellation would take place at a ask rate. So these has to be remembered very clearly, please, because bid and ask will not give a problem. Problem will be given by when I adjust the margins. So importer, when originally buying, he would have applied a ask rate. For the purpose of cancellation, it would be a bid rate which comes out. Exporter, original contract is bid rate. That means he would have done the agreement to sell, and reverse calculation is sell, buy. Buying is customer asking, bank selling, so it has to be ask rate. So in this case, margin has to be adjusted accordingly. If it's a before due date cancellation, now it's a before due date cancellation. Before due date cancellation is the agreement was done in 0 period, cancellation is taking place. So original contract of the importer was to buy dollar at agreed rate, and then sell dollar at what? 1 month forward rate. 1 month forward rate, because for example I have assumed here it was a 3 months contract, and after 2 months the importer want to cancel the contract. Since he wants to cancel the contract after 2 months time, it means the due period is 1 month. Actually the contract should get cancelled at this point of a time. So it's a 1 month forward rate. Original rule was buy, importer buy, and the reverse is sell. Now summary I have put it here. This you can take it in note so that you remember. Look at the summary, please. Important is importer, original contract is buy would be agreed rate, cancel is sell, on due date spot rate, before due date forward rate. Exporter, original contract is sell, which would be given to you, it's a agreed rate, cancellation would be buy, sell, buy, on due date spot rate, before due date forward rate. Copy that down, summary if you want. The important part is, remember the original rule of the importer exporter. Rest rules will frame up. Nothing to worry on that front. If it's on due date, it's a spot rate. It's a before due date, it will be forward rate. After due date, we'll come back once we've done these. Even extension of the contract, if let's suppose there is extension of the contract, it could be on the due date or before due date. the process will be same, and when he's standing on that date, he'll be given a new date. So you'll not even be there will not much difference between extension. Extension is standing on due date. If you want to extend, he will say cancel it out and take a new date. Before due date, cancel it out and take a new date. So accordingly, let's me cover some questions, then we come back to it. Look at question number 57. Let's look at question number 57. It says, you as a banker entered into 3 months forward contract with your customer, purchase AUD 1 lakh at the rate of 47.20. That means bank has done the contract to buy. Bank has done the contract to buy and customer has done the contract to sell. And customer will do the contract to sell when he is exporter, importer, exporter. Customer has done the contract to sell. Is exporter case. At 47.2500, this is nothing but agreed rate. They would have adjusted margin, etc. We are not bothered about this rate anyhow. However, after 2 months, original contract was 3 months. After 2 months, your customer comes to you and requests cancellation of the contract. It's a before due date cancellation. So before, it's basically a case of exporter before due date cancellation. The original rule of the exporter is sell at what rate? I'll have a habit of putting from the exporter's perspective. So if I put here, I'll put exporter original rule is what? Will divide into 2 parts, and make sure that in exam also divide in 2 parts such that you can read roughly numbers. So it's sell contract and then cancellation would be buy. Sell at agreed rate. Rate agreed was 47.2500, and then spot rate is of no use. 1 month forward rate will be used. Since customer would be buying, bank would be selling, what rate will apply? Ask rate. So it's buy at, since it's a 1 month before due date, 1 month forward rate agreement would be done at 47.5200. So it's a loss of 27 paisa to the customer into 1 lakh would be 27,000. Check once. Sell at agreed rate, buy at 1 month forward rate. Exporter original rule was sell, buy. Can you move forward? Rest languages, sir, should we make this kind of language? You can put the language. Exporter, for example, if I am putting exporter original contract was to sell, he'll sell. I'll show you in the question when we are doing. So language, don't worry. The books might give you the language of the bank, books might give you the language of customer. You make a consistency, customer's language. 58 question. It's an extension on due date. On due date extension means you'll cancel out and then you'll give the new date. Only problem which can appear is while finding a new rates or cancellation when the margins are given. So you have to be very confident and comfortable looking at the data. Read question number 58 please. It says, suppose you are a banker and one of your export customers, that means has become from exporter. By the moment exporter comes, if it's a cancellation, it should be exporter original contract is sell, cancellation would be buying. Booked $1 lakh forward contract, sale contract for 2 months with you at the end of 62.5200. That means if you think that you are an exporter, you would have done the agreement to sell to me at what? 62.5200. Simultaneously, you covered yourself in the interbank market at 62.5900. It's but obvious. Basically, what would have happened was, you would have called me, sir, I want to sell the dollars. I said, I'll give you the rate. I confirmed from some other bank, I want to sell the dollars. He quoted me rate of 62.5900, and then I said, I'll buy from you at what? 62.5200. Difference would be nothing but the margin which comes out. Anyhow, this rate is not useful here, but should be comfortable. Even if by chance you are not able to identify from the language it's exporter importer, by looking at rate you should be able to. Because if you sell to me at 62.520, I will not buy at 62.5900 from the market. It's a contract of selling. So I'll sell at higher rate and I'll buy from you at a lower rate. However, on due date, after 2 months, your customer comes to you and requests cancellation of the contract and also request for the extension of the contract by 1 month. So basically, if I stand here, let's suppose this was 2 months was a due date. On this one part would be cancellation. If I say cancellation would be, original was sell dollars, customer perspective, sell dollar at agreed rate, buy at what rate, and then from here to here you have to adjust, give what? 1 month forward rate. Who's asking for 1 month forward rate? Exporter, importer? Exporter. So if this part I'm leaving, let's suppose exporter is asking 1 month forward rate, exporter would have done this will become as good as original contract now. If exporter will do the contract, he'll do what kind of a contract? New contract, sell. So you'll give him what rate? He will sell, I'll do what? Buy, I'll give him what rate? Bid rate plus margin, reduce margin. Now whenever confusion comes, now margin will come confusion. It's not rocket science thing. Always think of position. You buy a property, what do you do with the margin? You sell a property, what do you do with the margin? You are buying a property, it's an importer. You will add margin. If you are selling, margin would be subtracted, bid rate, margin would be subtracted here. So do not be in a hurry to do it. It's 99% area of mistake is this only. So you cannot remember that note, it's fine. Just think of property perspective. When you are buying a property, you are buying property means customer I am talking about. It becomes easier for you. Customer buying a property, end up paying margin, it's an importer. Customer selling a property, end up paying margin, it's a minus. Second important mistake which made is, the cancellation when happens, what would he say? Exporter will do what? Exporter will, go the straight way. Original rule of the exporter was sell. So he will do sell at what rate? Agreed, which rate is already decided. Then he'll do what? Buy. The moment he buys, he behaves as good as an importer. The moment he buys, it's as good as you're buying. And when you buy something, it's an interbank rate plus margin. So do not be in a understanding that how can exporter have a margin. Exporter will be added margin for the purpose of cancellation. For the purpose of cancellation. And then when you are giving him a new rate after 3 months time, that 1 month time, then basically it's as good as a new exporter has come. So it's a selling contract from the exporter's perspective minus margin and give him. So relevant rate would be, for me, spot rate would come relevant. That's basically 62.7200 ask rate, because he'll have to buy customer, and then 1 month forward rate will come handy as 62.6400. This will come, and then margin of 0.10 buying selling, rates rounded off to 0.0025. One answer is given here. I think there could be slight change in the answer. I don't know. Answer I can show how you will present in the exam. Question number 58. Look at this line chart, please. It was exporter's angle, 2 month due date cancellation, original contract sell, bid rate which was already decided, margins were already adjusted, so you will not do anything with the original rate. Cancel, buy dollars at what rate? Spot rate, which will be a ask rate. So we have interbank spot rate. Interbank spot rate is given on that date. It's $1.62.6800 and 62.7200. Since he has to buy, it will be this rate applied. And second is, he would be asking for a new rate here. That means original contract of a sell dollars he'll take, bid rate, and merchant bid rate would be minus margin. So two things we have to do. what I have done is cancellation at ask rate. At ask rate is, this is 62.7200. This is the cancellation rate we are finding. Cancellation rate. So customer will sell, agreed rate, buy. The moment customer buys, it's asking. Ask rate would be applied. Margin of 0.10, 0.0627. It becomes 62.7827. 0025 rounding off will become 682.7825. Cancellation charges to be paid by the customer on extension. He will sell dollar at agreed rate, which was 62.5200. He will buy dollar at what rate? 62.7825. This is the rate what we have calculated. Loss on $1 and total charges he'll pay 26,250. If it was normal cancellation, at this point contract gets cancelled. Now since he is doing extension, tell me the forward rates which are available. Rates are available. 1 month forward rates are, I think, 62.6400 and 62.7400. Do not get confused, please. It's as good as new question now. It's as good as exporter is coming and he's trying to do agreement of selling. So customer selling, I would do what? Buy. I will buy at what rate? My buying rate is bid rate. And since you are selling, you will end up paying margin. When you buy, you end up paying margin. Customer, when you sell, you end up paying margin. When you buy, your cost increases. When you sell, your inflow decreases. So it's a bid rate. Do not attach this way. In bid rate we subtract margin, in ask rate we add. This can confuse you. Simple languages. If customer is buying something, his cost has to be addition of that margin. If customer is selling, that's as good as if you buy the share, you end up paying brokerage. If you sell the share, you still end up paying brokerage. When you buy, your cost increases. When you sell, your inflow decreases. So when you are selling a new contract, 62.6400 minus margin, it comes 62.5774, and then it's a rounding off it. Quickly check once, then we look at importer's angles also. Quickly go through it. Try to correlate the data points. Rest part you can make on your own. It is not tough. Just try to correlate the data points. And line chart helps me out understanding where I am standing and what rates to be used. That's it. There is no other purpose of the line chart. Rest you can avoid. Anything which is done from here to here, only for my reference purpose. This orange box, this is only for my reference purpose, so that I can make out what exactly is happening in the question. After that I make my flow. That on due date I am standing, what rate to apply, so I see the dates accordingly and then I move forward. And this first part is, if you have a sell, that contra would be buy, and then accordingly you decide the rates. Let's look at question number 59 now. Let's look at 59 and help me out in the drawing also of the line chart. Suppose you are a banker intend to forward purchase contract for $50,000 on 5th March with export customer for 3 months at the rate of 59.6500. It means bank has done the contract on 5th March. 3 months means 5th April, 5th May, 5th June. What kind of a contract you would have done? export customer. If I am a banker, you can say you are a customer or I am a banker. You would have done the agreement to what? Sell. I would have done the agreement to buy, and rate is decided. This is called agreed rate or a contracted rate. Sir, margins are adjusted at agreed contracted rate. Margins are adjusted. On the same day, you covered. That means he is talking from my perspective, bank, in the interbank market at 60.6025. Logically fits in well. That means you will sell to me at 59.6500. I will sell in the interbank market at what rate? 60.6025. That there was no use of this rate. I know there was no use of this rate, but logically you should know the process. In the after due date cancellation, this rate will be used. However, on 5th May, sir, where will we be standing? We were standing on 5th March. The contract 3 months means 5th April, 5th May, 5th June, and he comes on 5th May. That is 1 month before due date. Your customer comes to you, request extension of the contract to 5th July. On this day, 5th May, quotations are given. Let me draw in the line chart how the events are taking place. So please, this was 5th March. Original contract was 5th June. That was June. And then you are coming where? 5th May. That is basically 1 month before due date. An extension you are asking for how much? 5th July. That means I have to give you the rate of 5th July. Now, where should we stand and do every adjustment? 5th May. Now look at 5th May. I'm not looking at the rates as of now. I'm just trying to create my philosophy. It's a request for the extension now. So first I'll do is, it was what customer? Exporter or importer? Exporter. I'll do exporter. Original contract exporter is sell. Sell dollar at agreed rate, which is given in the question. Then sell would be cancelled with what? Buy. Buy dollar at what? How much date? No, it's not spot. You're requesting what? How many months? It's how many time? Forward rate. How much forward? 1 month forward, because the cancellation is not happening on due date. It's before due date. So if it is happening on 5th May, original contract was for what? 5th June. Actually, you can remember this way, although this is not the correct way of remembering. This contract which was done on 5th March, rate was of 5th June. So 5th June has to get cancelled with 5th June ideally. So in this case, since you are standing on 5th May, 5th June rate is 1 month forward rate. Now, exporter original contract is done at, you will sell, I will do bid rate. Now customer is doing what? Buy. You will buy at what rate? You are buying, I am selling, ask rate. So I'll apply the interbank ask rate, and since you are buying, your cost will increase plus margin. So this will be kind of a cancellation which will happen. Now sir, what about 2 months? From here to here, I look at 2 months forward rate, and 2 months forward rate. What will I see? I will look at, since is an exporter, exporter will do new contract of selling. So selling means I will give you what? Bid rate, new bid rate, and since you'll sell, I'll adjust for margin, that means minus margin. So in the same question, you have a plus margin and a minus margin both. Be comfortable what you're doing. Now let me look at the rates, please. Look up. Let's look at the rate. On 5th May, spot rate is of no use because nothing is happening on 5th May. One is happening what? Forward rate. So forward rate, which is cancellation, is at 59.2425 because it's a 1 month, 5th June. Na? Sir, what is the meaning of spot? Don't worry about spot. Spot is representing T plus 2. So it's basically 5th June, 1 month forward rate only. You're standing on 5th May. 5th May we are standing, and 1 month forward rate. It's an interbank rate. So cancellation would be 59.2425 plus margin. And then 5th July, exporters will take a contract at 59.6300 minus the margin. Now quickly do the numbers on your own and then cross check from the slide, please. Language I have dictated clearly. Quickly check the numbers on your own, and if there is a gain, amount would be paid by bank to the customer. Gain can be transferred. Quickly look at that, please. Do the numbers on your own so that if you make a mistake, we'll come to know where exactly we are making a mistake. And do the same way, two parts divide it so that life becomes easier. The date at which you are standing. Are you cancelling on at this spot? So use spot rate. If you are not cancelling at this spot, there is a forward contract still period left. Use that period. If it's exporter, original contract is selling. The cancellation would be buy. Since you buy, you will be applying a ask rate, and when you buy, it will be asking is addition of the margin. Similarly, when you are doing a new rate, leave apart the cancellation altogether. It's as good as you are a fresh customer and asking for a new rate to be quoted to you, either for a buying or for a selling, and then adjust the margin accordingly. Two parts it has to be done. And since it's a before due date, the profit and loss both can be shared with the customer. After due date, till on due date also profit loss can be shared. After due date, basically the problem happens is he will not share any profit and loss. Only loss will be shared, profit will not be transferred to the customer. Done. Cross check the numbers. That's it. There will be slight difference of the answer in the book, maybe because I copy pasted from your institute that answer. Slightly rounding off issues. This was again a exporter's angle. Now, independent exercise I'll give you. You take 5 minutes. Do not look at the answer at all. Make a mistake so that you are comfortable making a mistake in the class itself rather than going back and checking it. Try question number 46. Try question number 46. It's an importer angle. Do on your own. I'm 99% sure at one point you will make a mistake. Make that mistake, please. 5 minutes I give it to you. Try on your own. Importer request. Extend the contract. Extension on the due date. Remember, the original contract of the importer is to sell. Buy. And then cancellation would be buy would be cancelled with sell. Let me cross check. No need to write the fair answer, please roughly calculate the numbers of the numbers. And margin money for buying selling is actually rates are from the bank's point of view, so buying selling word is used from the bank's point of view only. That could be area of a mistake. If I look at my numbers, it says importer would have done the agreement on 30/10/2010 for cancellation. Original was buy at what rate? Contracted. Importer original contract was buy. Buy would be cancelled with what? Sell. That's one part. And since it's a due date cancellation, what rate will apply? What rate? Importer is cancelling, buy, sell. Forget about the importer also. Once you know sell, that means you are selling, I will do Y, bid rate would be applied. So bid rate would be applied, and since I would be buying, you would be selling, margin would be subtracted. Then 3 months forward rate would be, importer is asking for a 3 months forward rate, new rate. It will be interbank rate. Since importer is asking, it's a add margin. Now cost to the importer, when we look at this, it's due to cancellation, buy at contracted rate, sell at spot rate 41.5000, that was interbank rate minus the margin. It's a, sir, why have we applying buying margin? It, the buying and selling rates are from whose point of view? Bank. So do not get confused in that buying selling, because we use the language customer, but the since quotations are from the bank point of view, buying selling margin is also from the banker's point of view accordingly. So it's 41.4689, the loss comes 0.85, 11, loss on 20,000 will come 17,022. Then we have a rate for 3 months. Since spot interbank rates are available, we need to find a rate for importer. Importer would be first, let me find the rate 3 months forward. So 3 months forward would be whatever we have a spot rate, since premium is given plus 0.93, that will give me a interbank 3 months forward rate, interbank. And then while quoting to the customer, I'll add what? This is 3 months interbank forward rate. While quoting the customer, add margin. Now check your answer once again. Do in systematic parts, please. Do not look at both the rates simultaneously. Spot rate is only used for the purpose of cancellation. Margin was adjusted. New rate would be spot rate plus premium will give you 3 months forward rate. Using that 3 months forward rate, and plus you'll do what? The margin, because you're giving quotation to the exporter. If you're giving quotation to the exporter, you are subtracting margin and you was using a bid rate. Now since you're giving a quotation to the importer, you're applying what rate? Ask rate. Done? One more question I want you to try on your own again. Do not look at the answer, because we'll be covering 1, 2, 3, 4, at least 4, 5 more questions. I want you to get comfortable by the time we come to the extreme level. That you're comfortable, make a mistake. If you're making a mistake, go back home and just try to see where are you making a mistake. Generally, what I have seen is 2 areas of mistake. One, you read both quotations simultaneously. Second, the margins. Margins will give you a problem, because adaptability is very less. That why are we adjusting to the importer as a minus margin, importer should be plus margin. So it's, you have to be careful about, if you are giving a new rate for the importer, it's plus margin only. So when you are giving a new rate to the exporter, it's a plus margin only. But when you are cancelling, the importer is behaving as good as the exporter only. So cancelling, basically you are trying to cancel out the contract. So how this contracted rate was determined? It was decided 3 months back. -3 here is 3 months back basically. It was decided 3 months back. Does this include the margin? Yes. Because for example, you are deciding this rate 41.4899, this new rate. This rate stands where? At this part. Let's suppose someone cancels the contract here. So he will refer this rate was decided when? It was decided 3 months back. So everything was adjusted. You do not have to do anything with the contracted rate. Anything which is standing on today and you are adjusting accordingly has to done the adjustment for. Now there is a question which is on exporters extension or cancellation plus cross currency. Should have given. Yes, I have given. Question number 68. Question framing was not very nicely done. You do it, get confused, and then I'll tell you. You'll get confusion for sure, because if I do it, you might not get that confusion. You read it once, you'll get confusion for sure. Read out the question with you. A bank enters into a forward purchase TT covering an export bill for Swiss franc 1 lakh at rupees 32.4000 on 25th April and covered itself for same delivery in the local interbank market at 32.4200. However, on 25th March, exporter sought for cancellation. That's 1 month before due date of the contract as tenor of the bill is changed. In Singapore market, Swiss francs were quoted against dollar. In the interbank market, US dollar were quoted against the. Now basically what is happening is it's a exporter cancellation before due date. Exporter cancellation before due date. Original contract, if I try to put here, original contract was to sell at agreed rate. The cancellation would take place at what? Buy at 1 month forward rate. Now let us try once more here. Sell at agreed rate. Agreed rate is known to you, 32.40. 1 month forward rate. What was the agreement to sell? Which currency? Swiss franc. And he would have received what? Rupee. Now he will buy what? He will sell what? Swiss franc. And he will buy what also? Swiss franc. That means when we have to find this now buy, we have to find relationship between what and what? Rupee and Swiss franc. Rupee and Swiss franc only. You have done the agreement to sell Swiss franc. You will do the agreement to buy Swiss franc. When you do the agreement to buy Swiss franc, let's suppose leave apart the selling buying. If you do the agreement to buy Swiss franc, you will buy, I will do what? Sell. So what rate we need to find? Ask rate. Rupee per Swiss franc, ask rate and 1 month forward. Please understand, 1 month forward. It means my relevant rate would be this 1.5150, 1.5160. I'll try to see how do I put this rate. Basically, this is actually Swiss franc per dollar, and then I need Swiss franc bottom, so I'll put dollar per Swiss franc. And in this there was a confusion. This rate would be of no use, 2 months would be of no use, 2 months would be of no use, no use. These were rates were confusing. Now should I write, sir, 49.4100, 49.4200, or should I use them as a premium points, low high? It's actually confusing. I think at one of the solutions institute might have given alternative both, but my advice would be, if you look at the just question before above, if you are given this space 63.80 oblique 63.9200 oblique, then you use normal quotations. Otherwise you can safely assume them to be either premium points or discount points, because actually practically what happens is the pips, they talk in this term only. They never talk 49.4100. They talk in these term only, and they know that what is the market quotation which is there. So there is some different way of terming in the practical life. What you will do is, using these two and applying a low high form, you will find what 1 month, the 1 month forward rate, and this is nothing but rupee by dollar. And what I need is, I need rupee on the top, Swiss franc on the bottom. Once again I am making my framework, please. It's a cancellation 1 month before due date. Since it's a cancellation 1 month before due date, we need to find what? We need to find 1 month forward rate. So agreement would be done at 1 month forward. 1 month forward would be using this rate, and 1 month forward would be what? Using these two rates, because spot rate and this rate will apply 1 month forward rate. Second important part is, zero period you will do the original agreement would be what? Sell dollars at what rate? Agreed rate. So you will sell Swiss franc at agreed rate. Cancellation would be buy Swiss franc. Buying Swiss franc with which currency? Rupee. So it will be rupee per Swiss franc what rate? Ask rate will be applying. You have to be very comfortable about it. Ask rate, that means I will be using, depending on circumstances, whatever comes as the ask rate. Numerator should be rupee and denominator should be Swiss franc. Now quickly try out, please. I have solution 8. Quoter's angle 25th March, 25th April was due date. He requests cancellation. Original contract, sell at agreed rate, cancel, buy at 1 month forward. Since India is exporter, hence we need to find rupee per Swiss franc ask rate for the purpose of cancellation. Words are very clear. It's not exporter is finding a new rate. It's exporter is cancelling. So exporter original contract was sell. He will do the selling agreement with what? Buy. Since you do it with buy, for the purpose of cancellation, you will find what rate? Ask rate. So 1 month forward rate, $1 Swiss franc is available. 1 Swiss franc. Out of these quotations, I'll be using this Swiss franc bottom. One would be this. Then I need is 1 month rupee per dollar. Rupee per dollar. I was given spot rate. Add the premium points. When you add up the premium points, you get 1 month forward rate 49.8402, 49.8655, and since you require rupee on the top, so you can use definitely rupee on the top. This you can use first one. So 1 month forward interbank rate you will get 1 month forward interbank rate by multiplying 49.8655 and 1 divided by 5.50. 1 divided by 5150, we get rupee 32.9145. 32.9145. Now, is it a ask rate or a bid rate? Ask rate. When you asking, you will add up margin and pay or subtract margin? Add up margin. You're asking, that means you're buying. What is buying? So 1 month forward merchant rate would be interbank rate plus margin, that will be 32.9474. Loss to the customer on cancellation. Sell Swiss franc 32.4000. Buy Swiss franc 32.9474. Loss on 1 Swiss. Loss on total. It was a cross currency plus cancellation before due date. It was a cross currency plus cancellation. Excellent. Question is, they have given in Singapore market Swiss franc were quoted against this. The question is, nowhere it is mentioned that it's a interbank market rates. Says, and in the interbank market it is mentioned here interbank, but for this it is not mentioned, it's a interbank. When margin is given, it's always interbank rates. Everything it's interbank only. Rates are always interbank because they quote bank and bank only. Interbank specifically mentioned, it's fine. Lot of places interbank would be specifically mentioned only. Most of the places they'll mention interbank only. Otherwise, if it's not mentioned, then you adjust for the margins accordingly. Done. Now cancellation after due date. Amendment came in 2020, I think, in the topic. Although you will not even come to know, questions would not change as per your way will remain same. Earlier there was a concept, these are based actually on the FEDEI guidelines. It is not something which I am doing from my side or which is required. There are rules, rule 6, 7, 8, 9, 10, there are some rules. Based on that we are doing this topic now. So I am not discussing any of the rules. I'll just tell you what exactly has to be done as per those rules cumulatively. As per these guidelines, if I go before 2020, if on due date customer does not come, then after I think 15 days was automatic cancellation. And the question used to give you a date of 10th June and 20th June somewhere. Now it has become 3 days. So the dates now will be, earlier it was 10th June, 20th June. Now the dates will come 10th and 13th June. Things will not change much for you. Only things will change is that interest will be for 3 days or whatever has to be done for 3 days. And then there is a concept of a swap which comes out. The slight logic of the swap, I'll tell you what exactly happens is, I'll just make a rough diagram. For example, let's suppose in importer is standing here in the 0 period, and I'm taking the same numbers which have, since generally you will have either 10th June or 10th September, they'll only change some few. Importer would have done some agreement at 0 period point of a time. Importer would have done the agreement of June. How many months? Leave apart. The importer would have done the agreement to buy. So buy means he would have done the agreement to buy. Let's suppose $1 at 62. That is exactly he would have done the agreement, and total $1 lakh. Just taking a rough number so that you can read the numbers well. Now we have done couple of questions by now. Maybe some of the question which is said, you did the agreement, bank has done the agreement, and bank covered itself. Bank covered itself, but we never use that covering position. Now what this agreement is, you are importer, I am a customer, you have done the agreement with me, you'll come on 10th June and buy from me dollar at what? 62, and certainly bank would have done the agreement on 0 period only on 10th June. In which market he will buy? Interbank rate, maybe $1. Let's suppose he'll buy at 60. I'm just assuming. That means you do not know. That shopkeeper only knows what agreement has been done. It is as good as you have given the order to me, you'll come in the evening and take a cake. I have given the order to someone else. That's it. It has been done. Now what happens when on 10th June, what I do is, you ordered a cake for to receive from me. I ordered somewhere, I got the delivery. That means I have to buy. I bought the dollars. Now who is doing? Bank is doing on 10th June. What bank will do is, bank said customer will be coming, I buy the dollars. This is bank language I'm writing. Buy dollar at agreed rate. That was he bought at 60. He would have bought. Now he waited for you. If you would have come, he would sell you what? 62. That's exactly the question happens. But when he was shutting his shop, you did not come. That means you did not come. And since the dollars are lying with me, I tried calling you up. In number of things I tried, but you were not reachable. Maybe the network's jammed. Maybe the connectivity was not there, or something. Anything can happen. So risk cannot remain with me in the balance sheet. So when I bought, it's a bank doing 10th June. Customer has not turned up. Bank will do sell dollars at what rate? At, let's suppose 58. I'm assuming he sold. Now actually this is a loss, but this loss is not the loss I'll cover you. This they treat as an outflow. Loss we'll see when we cancel the contract, because otherwise there will be 2-3 times the loss will come. I'll show you once we move there. One transaction which will happen on 10th June is, bank, I'm a bank, I have done the agreement to buy. I will buy. I waited for you. If you would have come, I would have given it to you. That's it. There would have been no problem. But you did not come. That I did what? I sold dollars at spot rate. Now the guidelines require, there could have been some problem with the customer. He might not have been able to come due to certain reasons. Although I have seen the question mentioning about the swap, there remains some problem in that swap wordings which will confuse you. The swap transaction, for the exam purposes, now this transaction has happened, which has happened. Don't worry about this transaction. Now think the different perspective. What I did was, I waited for you. I sold at this spot rate. You did not turn up. Now there could be a possibility you might come tomorrow morning. If you come tomorrow morning, next day, I do not have the availability of a dollars. So what bank does is, banks make sure that before closing today, he arranges for the availability next day. The swap will be done only once. Actually it could be done for few days, but now since the period is so small, it will be done only once maybe. In that case, what I do is, for example, you ordered a cake to me, I ordered for someone else, and he brought, you did not come up, I sold it off. Then I am worried that if you come tomorrow morning, then I have ordered a fresh cake basically. So what I do is, it's the transaction he'll do is, the buy dollar at, I am not using a word 1 month. Your institute uses 1 month. That's a wrong language, but I'll show you what exactly means. At the nearest rate, nearest forward rate. This will be a confusing language which we'll discuss when we're doing the question. At the nearest forward rate, basically this cell will become part of this transaction here. Sell dollar at what rate and buy dollar at a nearest forward rate. Now swap basically means it's a sell buy swap. Logically remembering may be a difficulty. Logically remembering is how I bought the dollars for you, you did not turn up. So two things I had: either carry forward this risk with me and wait for you tomorrow, or I sell today and buy 1 month forward. I sell today and buy 1 month forward. That is how the swap is created. Simplest way to remember is, because we'll be doing some exporters, early receipts and so on, delivery, this transaction what comes here becomes first part of this. Logically, if I would have done, I would have said, I brought dollars for you, I waited for you, you did not turn up. Now, as per the guidelines, I have two options, means as per the common sense I could have done was, since today you've not come up, maybe tomorrow morning will come up. So this dollar, either I should carry forward till tomorrow, that's one option, which logically I am thinking. Second is, I should sell this dollar and take a forward contract. When I sell dollar and take a forward contract, we call this as a swap transaction. A swap. So that swap would be done, and then let's suppose, since an exam question would come automatically, it will be a 13th June only, he'll not give you in between. Automatic cancellation will take place. Either the customer will come or not come. If the customer comes and say cancel the contract, if you cancel the contract, then whatever cancellation charges you charge him, those cancellation charges will be charged here. And that was the reason we did not charge here the loss, because if I charge here this loss also and difference of that loss also, that will be duplication of the loss. So one is the cancellation charges will be charging. This bank will treat as an outflow. Interest on the outflow bank will charge, and third bank will charge is this swap loss. If there is a gain, bank will not give us. If there is an inflow, bank will not give the inflow. I'm again saying what has to be done is logically do it. You do only this first part, rest part automatically will be made. The bank would have done the agreement to buy, bank will buy, and since it did not come up, bank sold. So buying, selling, one part is over. Second thinking way is, bank brought, you might come tomorrow, since you did not come up, bank will do sell and take buy 1 month forward. That 1 month forward he'll give, we do by the, as per the FEDE guidelines, whatever is the nearest rate possible, will take the contract. So he'll take nearest forward rate. In exam, he gives a rate which is 1 month forward. So I'll show you, and that is also not the problem. Problem is something else. Shall come back. So you can remember this cell which comes, this cell is same. This cell would be same which comes out. So this is a swap transaction. When the customer actually turns up, the customer will be charged his cancellation charges, which we normally charge him. Then any outflow interest will charge him, and then any kind of a swap loss would be charged here. No inflow would be given, nothing would be given, and no gain would be transferred. If he says cancel, take him the 3 charges, cancel the contract. If he say want to execute, still cancel, give him the new spot rate. If he says I want to extend, still cancel, give him the new rate. That has to be done, which is there. So that's, date has changes, 3 days time has changed. It's basically, we call it as, customer has done the forward purchase agreement, I have done the forward purchase agreement in the interbank market. If you do not turn up, I still fulfill my contract. That is, first part is fulfilling my contract, and I create a swap transaction for me, you. That is basically, ways of remembering is, what I bought for you was either I should have carried forward, or I sell and buy something new for you, a fresh for tomorrow, so that risk is not lying overnight with me. You never know what happens. Let's suppose war happens overnight, then bank would be under pressure, so there could be a bursting out. So no banks carries any kind of overnight positions. While shutting down their shop, they make sure that minimal risk they carry in their balance sheet. One day, it can be with the anything, it can be with the markets, it can be with the equity markets also. Generally, you will find in risk management question which have started coming in your exam, they do not carry any kind of a risk on Friday. Saturday, Sunday happens, you then do not know what will happen. Leave apart normal day, if someone would have carried position on Tuesday, idea, you would have known what happened on Wednesday. A single 10 paisa he costed was 2.5 to 2 lakh rupees worth. So the risk is very heavy. Maybe you are not able to see that risk, but generally a big traders, banks are anyhow under regulatory guidelines. The big traders, no one carries any position any day. It's a fresh market every day. What will happen today? What I'm getting, I'll get tomorrow slightly costlier. It's okay, but I'll be able to sleep. But one day is enough to wipe off everything. It's such a bad market which comes. And in history, tomorrow will happen a second time when the markets will open. One Saturday it opened some time back. Tomorrow would be another history which you'll watch. Market would be open Saturday. 1.5 hours from 9 to 10:30, I think, and then 11:30, 12:30. Twice it has happened. Some time back it happened when 22nd January was Monday, I think. 20th January was Friday, Saturday. That happened normal day. 22nd was given holiday. This is the second time which is happening, and the expiry which happened yesterday, expiries happen in the equity market is last Thursday of the month. Yesterday was 29th Feb, last Thursday of the month. This will come now after 28 years. 29th Feb expiry. By that time you will be there. I don't know about me. You will be sure there. Watch that comes out. So risk is not carried. This is basically about the risk management. Let me go to a question before these are as per the FEDI guidelines. I am not dictating any rule, regulations, requirement, anything. Let me go back and let us see now how we'll do it. I'll read out question with you. That question will make a framework. The problem actually happens with the data points. Problem will not happen with these points. These points you'll remember. Problem will occur is when we read those data points. They are not nicely given. Question number 67 in your book. It's question number 67. Now let me look at this. It says an importer booked forward contract with the bank on 10th April for USD 2 lakh due on 10th June 64.400. That means importer done the agreement to buy and bank covered its position at 64.2800. That means you came to me, you said you'll buy from me at 64.400. I have done the agreement in the interbank market to buy at 64.2800. What date? 10th June. This was the June. Exchange margin, the exchange rate for dollar in the interbank markets on 10th and 13th June were given. Exchange margin 0.10, interest on outlay 12%. Importer requested on 13th June for extension of the contract with due date on 10th August. Rates round up to 4 decimal multiples of this. On 10th June, bank swaps. This is the line they give. Bank swaps by selling spot and buying 1 month forward. It's not actually rates were given 1 month forward. Confusion in the rate comes, which I'll discuss with you. As per the guideline, it's the nearest rate possible. Then calculate these points. Now this is a cancellation question which comes out. First of all, when the question was framed, you know what would have happened. Let me see my diagram first. What will take place? The transaction. If I draw my perfectly fine, nicely the presentation on 10th June. Actually, this is a first understand the question which come in exam. When the question comes in exam, examiner knows what was the due date and when it is getting cancelled. Now let's suppose today is 10th June and there was a customer who was supposed to come on 10th June. He did not come. You know what entry you will pass on 10th June? You will pass only 2 entries on 10th June. One is what? This, and second is what? This. Now let's suppose exactly same position. Today is 10th June, today was the date and you are a banker. You purchased something, no one came, you sold off, then you sold and created a swap. What is the nearest date? When I go, actually why problem happens is, today standing, can you tell me customer will come tomorrow or on the, today is 10th, 11th, 12th, 13th, 14th, 15th, how do you know when the customer will come? Or let me put a straightforward answer. When will Vijay Mallya come? Or when will Nirav Modi come? Let me put this way. We don't know. But actually when they will come na, and when someone is making a question, he will make, he went out of India on this date. On this date this happened. And on this date he came. And when the question comes in the exam, everything is known. My problem, understand what is there. The question knows on 13th June he came. But on 10th June the question did not know when he was standing on 10th June. Na, he could see only, please look up and don't look at your screen. On 10th June when question was standing, he knew only these rates. Actually problem student faces is, when I say create a nearest possible forward rate swap, he says, sir, forward rate nearest is 13th June. I am saying this, sir, which date is this? Let me assume this is 30th June. Let me assume this is 30th. 30 happens na June. 30 happens. 30th June. The moment I write 30th June here, some of you will have a problem. Sir, how can 30th June be earlier than 13th June? The problem is this. First get the problem right. The problem is when on 10th June rates were decided, today is 10th June and I was standing in the market and I asked someone what is the spot rate today? Today is 10th, assume today is 10th. He said spot rate is 63.800, 63.8200. Then I asked what are forward rates and he gave me this rate. And he gave me of a 30th June. Then I don't know whether it's 30th, 31st July, 10th July, August, I do not know, but he gave me these rates. Now standing here, I waited and I said now it's the end of the 9 o'clock happened, we have to wind up. So what I did was I purchased, I was a bank, I did my agreement, I purchased and I sold, and then I was going forward, then Federal guidelines come in between, they said create a swap. I sold and what? 1 month forward or nearest rate possible. Standing on 10th June, which is the nearest rate I can see this as the nearest rate. But sir, the moment we do this way screen, we can see 13th June. 13th June, you know, because customer came on 13th June. In 10th June, 13th June was not available. If I would know on 13th June he is coming, then I would not even create anything. I'll say, oh, I know 13th June he'll come. Why take a burden? Let him come 13th June. Settle down 13th June. Understand the problem, please. Some of you will have that problem and not you. Everyone have that problem when they look at, because you look at the question in entirely. This question was framed when examiner was framing this question. He know contracts were created on 10th June. On 10th June, these were the rates available in the market, and whatever has to be done this way. It's as good as if today I stand, I ask what is the price of the idea for the month of March end. I know today. On 13th March or 14th March, rate will still be available, but I cannot do the contract standing for 13th and 14th March. If I am doing standing today, I will do the agreement whatever the rate is standing as of now. As of now, my rates available with me are these only, and to this nearest rate which is available for the swap is this rate which is available. 13th June, you know it, because to complete the question he had to give you that 13th June. So maybe 13th June is very near to the 10th June, but since you were creating swap on which date? 10th. On 10th June, 13th June was not on. By chance, what happens if he comes on 12th June? Then what? Or what happens if he does not come on 13th June? Then what will happen? That means you stand on 10th June, whatever are the rates available on that date in that slab, nearest rate we call it as a rate for the purpose of swap. I hope you should get clarity, because I've seen students gets confused because sir, 13th is very near to the 10th. It's near only because you see the in entirely. When you were standing here, you were only able to see 10th and you were able to take an action based on the rates which were available on 10th of June. So what I'll say is, I'll create my line chart accordingly. I'll say on 10th June, two events will take place in the hand of bank. Bank buys agreed rate, bank sells at spot rate. Interbank would be the same selling and buying. Although question is mentioned, we'll do bank sell and bank buys at forward rate. This has to be the nearest rate possible. And when we use a word nearest rate possible, nearest rate in the 10th June is, if this is my spot rate, if this is first is my spot rate, then sir second also he said spot. Spot he is only using for T+2 that system. That's it, nothing else. The spot nearest is available. If this is my spot, nearest is this rate which is available. Then the gear will shift to 13th. So the moment 13th comes, customer comes and says cancellation. I'll say you are standing on 13th. Now let's talk from the 13th rate. So 13th rate I'll see. Interest on outflow, what happened here, whatever number of days I'll charge him the interest, and the swap loss, whatever happened here I'll charge. And then if he says new contract, be careful on this also please. This is also confusing. He's standing on 13th and asking for the rate of what? 10th August. That's also one of the gray areas of the exam. Sir, which rate should we take? Generally when I ask a student in the normal class, he says, sir, if these are, this was question number what? 67. Generally he will say, sir, If this is 10th June, this is what date? I don't know. I assume 30th. This July, sir, could be 10th July. This August can be 10th August. This September can be 10th September. I have no idea which dates. When I'm standing on 13th June, this is 13th June, I know. This is what June? Maybe 30th June. This is what July? I have no idea. This is what August? I have no idea. This is what September? I have no idea. Standing on 13th June, he is asking for the new rate of the August. When he is asking new rate of the August, please, you cannot go back in history and do the agreement at these rates. You cannot do this. Even though they were of 10th, I have no idea whether they were of 10th or not. If you are standing on 13th, the August rate available to you is what? This rate. Is this of a 10th or 13th? How does it matter to you? For the month of August, there is only one rate given. Assume this is of what date? 10th August only. So dates gives you confusion. It's as good as if I am standing today, I know the rate of idea is 14.2. Wish I can go back to Tuesday. I can create a short position heavily. So it cannot happen. You cannot go back and create the position. That means you cannot go back to the 10th June and create a position here. If you are standing on the 13th June, you can create a position based on the rates available as of now. That has to be there. So 111, I'll take it up. Before you do it, just copy this diagrammatical presentation if you want. Then I'll take up the fresh answer. You should have a clarity. Events are taking place in whose hand, what date. Why it is important, sir? Because when you are doing in the bank hand, it has to be all interbank rates. When you are doing in the customer hand, it has to be the merchant rates, adjustment of the margin which comes out. So on 10th June, two transactions will take place. One in the hand of a bank, which is normal buy, bank buys dollar at spot rate, bank sells, and second is swap transaction. Swap transaction is bank sells and bank buys, and then 13th June it will take place in the hands of the customer. Copy this part, then I'll move forward. Now by looking at this, I would be able to decide the rates basically, standing on which date. Otherwise, rates will give me a confusion. This will help me in deciding rates. First part in the question he is asking about is the cancellation rate. Now, if I look at cancellation is happening on what date? 13th June. So I'll stand on 13th June and take a call. It's the customer who is cancelling. Import customer when cancelling. Importer original contract was to buy. Cancellation would be sell. If you sell, I'll apply which rate? Bid rate. You are selling minus margin. So if you look at, I go back to the transaction again. So cancellation rate, when I look at, the cancellation will take place at a bid rate minus what? Margin. So date is what? 13th June. On 13th June I am standing here. 13th June I am standing. It's this rate 63.6800 minus 0.10 margin. That will be the cancellation rate. What will be decided? So let me look at the first part answer. Comes out this cancellation rate. I have cancellation rate equal to, standing on 13th June, these two rates were available. Since it's an import customer, importer will cancel at this rate minus what? Margin 0.0637, and you get Then second part he is asking is, once you do this, that basically cancellation rate means it's a buying rate for the importer, selling rate for the importer. So importer will buy at the agreed rate, importer will sell at this rate, difference between them would be a loss or gain. Second part is that only. Once you've done this part, second part is, if I look at, second he said find gain or loss, no, amount payable on 2 lakh. Amount payable on $2 lakh. We say customer will buy, I've used language very clearly, customer will buy dollar at agreed, which was given in the question, 64.4000, and customer will sell the rate which we have just calculated, 63 point, this rate we calculated, 0.7825, and on $2 lakh, 156,500. This loss would be paid. These are actually the kind of cancellation charges. They'll be paid when the contract is getting cancelled on 13th June. That is one charge. That is first charge. So basically what we did was, we just found normal question we have done, that's it. Cancellation rate you normally do it. If I was not giving you this question, you would have still done the same way. Whatever date he comes, on that date what is the rate, we do it. So rate is applied 63.6800, and then accordingly cancellation take place. That's first part. Then he says create a swap. Although question specified, swap would be created by selling spot and buying 1 month forward. You should know which date should I stand. Swap transaction is created on 10th. So stand yourself on 10th. When you stand yourself on 10th and you sell at spot rate, it's who doing transaction? Bank is doing. So rates would be same, bid and ask, what you would have applied, but only difference is I will be applying at what rate? Interbank rates. So the only difference is the interbank rate, nothing else. So when I go back, the third part he said was swap loss. Now if I look at my diagrammatical presentation, swap transaction is created on 10th June. I'll stand on the 10th June, although question mentioned bank swaps by selling what? Spot. That means bank will sell at spot. Now bank is not selling to customer. Bank is selling in which market? Interbank. That means interbank, when you sell, which rate apply? You sell, bid rate. When you sell to me, bid rate. When I sell also, I'll apply what? Bid rate. I'll apply interbank bid rate. And bank buying 1 month forward. When you buy, it's a ask rate. When I buy, it's still the ask rate. And nearest rate on this date, 10th June, is this part here. Please do not look at 13th, because on 10th June when you were standing, these were the only rates available. Spot rate was this, and to the spot nearest rate available was this. That's it. Even if the question is not specifying, still it was the nearest rate. It is not 1 month. It is the nearest rate possible which comes out. So it's 63.9500. That means swap would be bank sell at what rate? 63.8000. Bank will buy at what? 65.9500. Even if he would not have asked unsystematically, systematically how I would have done was, on 10th June bank brought the dollars for you, you did not come up, bank sold, and then swap would be bank sold and bank buy 1 month forward. So automatically that chain would have come. Since he is asking in the point swap first, I am doing bank would buy at this and bank would do what? Sell at 95. If I look at the swap transaction, third point, swap loss. So we have, I've written here also, as per the FEDI guidelines, the buy has to be created at the nearest rate possible. In this question mentioned, even if it would not have mentioned, still I would have done the nearest rate possible. It's 63.8000 minus 63.9500. 0.15 into how many dollars we had? On $2 lakh. That's the swap transaction. It has to be nearest rate possible. Then he is asking calculate interest on what? Outlay. This calculation would be standing doing on what date? 13th June. 10th outflow happened, but if let's suppose he comes on 12th, it will be 2 days. Since he is coming on what date? 13th. Interest will be calculated on 13. When you look at the diagram, you will come to know the cancellation was done here only, outflow, the interest and outlay. Now automatically first I'll have to calculate this outflow. I'll have to do this outflow, because unless until I know this outflow, I cannot calculate my interest. Bank will buy dollars at agreed rate. Was this rate given in the question? Yes. Bank will buy in which market? Interbank market, 64.2800. Bank buys and then bank automatically do what? Sell. Sell at 63.800. This is same sell part of the swap. So bank buys, bank sells 63.800. There is an outflow which happens on 10th June and then interest would be calculated on 13th. So rates are of 10th June. Rates are of 10th June 64.2800 minus bank will sell at 63.8000. It's a 0.48. 96,000 and 3 days interest would be 96, which comes out 96 comes out. Actually he asked unsystematically. If he would not have asked, I would have done systematically. 10th June 2 transactions, 13th June 3 transactions, then I will say whether you want to cancel, extend or what you want to do, let me know. The sixth part I'll do first. He asked what total cost. So if you look at the answer I have one as a swap loss which I'll be charging to the customer. Second, I'll charge this interest. Sir, will we charge this outlay? Actually twice calculation will take place if I charge, because difference of these two is a loss and I am already charging him one loss, this 156,500. So I'm not charging him two losses. It's 156,500 is a loss to him. 30,000 is a swap loss to him. 96 is what? Interest. Then total cost to be borne by the customer. Amount payable on $2 lakh, 156,500. Swap loss 30,000. The interest on outlay 96. The interest on outlay 96, which comes out. The cost has to be borne by the customer whether he goes for cancellation, extension or settlement. No matter what he want to do, under all circumstances he has to bear the cost. Once he bear, and then he is asking standing on which date? He was standing on which date? 13 June. Now stand yourself on 13 June. Do not look backward, please. If you do the backward, that means you are able to do the agreement at the back date. Back date agreement you cannot do. It becomes very uncomfortable, I know. Standing on 13 June, sir, the rates which are mentioned under 13 June are of what date? The dates, whatever you believe or you see, I also see the same dates. So if I go back to that question again, I'll stand myself on 13th June. On 13th June, when I stand, I am able to see these rates. This is spot rate of 13th June. This is forward rate of June. Date I don't know. This is of July. Date I don't know. This is of August. Date I don't know. This is September. Date I don't know. I know for August only these dates are available. Now some of you might say, sir, this could be 10th. I agree, this is 10th, let's suppose. But how can you stand on 13th and do the agreement of the back date of the 10th June? You cannot do. That means only possibility you have is standing on 13th. If the rates are available, you'll assume these rates are of which date? 10th June. Actually, examiner only knows what he's doing. He only knows. We are just guessing that this is this, this is this. That's why I'm saying when he's framing a question, he should be framing nicely. He should know that he is not framing a question for the general purpose or the suspense part he is doing. Not a suspense paper. Give us the dates. Logic you check, it's okay. Tell us this date is what date? Because that confuses. Otherwise, practical life, first of all, he only knew 13 June he is coming. Otherwise, no one knew 13 June he'll come. So if you are standing on the 10th, please make sure you are looking at the dates of only 10th. Then 13th came. By chance, customer also came. And then examiner knew both of them and he framed the question. And when he was framing question, he was standing on 13th and giving the new rate. That means if today is 13th and I am giving a rate, as per today's rate, the August rate are these two, and you are a importer customer or a exporter? Importer. Importer would be given which rate? Ask rate. It will be 64.2500. 64.2500. That means standing on 13th June, it has been assumed, inbuilt assumption, The rates which are mentioned in front month of the August represents 10th August. You did not have any choice, no need to write that note also. So basically when you go back here, then I write my question accordingly. I'll say new contract. Importer is asking, it's a new contract rate. The new contract rate. I did fifth part last because summarize the first parts. Importer is asking for new rate on 13th June for 10th August. Hence we need to find merchant ask rate. Interbank rate of 10th August. Sir, these were 13th June. Whatever rates are standing in front of the month of August are of 13th August, 10th August. This rate plus what? Margin. If by chance you feel like anyone that sir can't we take the 10th under the 10th, then I wish I have, give me 3 days time, I can go back and do any contract. Today Nifty increased by 350 points. Give apart 3 days. Tell me to go back yesterday history. I can do the contract standing today. For example, I am standing today. The expiry is 28th March. 29th is Good Friday, Saturday, Monday. 28th March is expiry. Yesterday also 28th March rates were available. Today also 28th March rates are available. If I do the agreement today, I'll do the agreement at the rate available today. I cannot go back. Yesterday idea share was available at 13 rupees 60 paisa. Today it is available at 14 rupees 30 paisa. I cannot go back and do the agreement. Date is same, I am saying. It's as good as one property is being built up. Builder says, I'll give you delivery in 2026. I went 3 months back, then also he said I'll give you in 2026. I went 2 months back, then also he said I'll give you in 2026. Today also I went, he said I'll give you in 2026. I asked rate, he said 1.5 crore. I said 3 months back you said 1.2. You said 3 months back was a history. I hope you understand what I'm saying. So could be a possibility. What I want to tell you is when you're standing on 13th June, I did not go to buy a property, that was just example. All examples are for notional purpose and alike. It's basically if any doubt comes na, sir, standing here, can we assume this rate of 13th? It is not so. You have to assume this is of 10th only. If this is also of 10th, you cannot go back and do the backdate agreement. It has to be done at the date today available. For example, tomorrow market will open. If you do the agreement for 28th March, tomorrow's rate will be able to do. You cannot do at today's rate. This is the major confusion which comes out. First confusion comes is why swap is done at this rate, because to this is the nearest rate. You do not see this way. It's not this way. See vertically, because on that date what were the rates available. Second, the agreement which you are doing standing on whatever date will do the agreement. And best part is if question does not specify anything, just simply make these are the possible scenarios. On the due date, 2 events in the hand of bank, and on the date customer comes, it's 3 things in his hand: cancellation, interest and swap. Then whether he wants to extend, whether he wants to cancel, or whether he says I want to execute the contract. You ask first bear the charges, and then you ask him go forward. No matter whether the cancellation happens, no matter whether the extension happens, no matter whether the settlement happens, no matter what happens, charge him all 3 items. And then in this particular question he was asking for what? New rate, and you will give him the new rate. This was the new rate available. This was the this was cancellation after due date. Now I am moving to the early delivery, exporter importer. Early delivery, I would Yes, exporter I have given. I have given with the example only. Get the data point, please. This will be much easier to understand from the swap transaction point of view. Exporter I have taken here. This is what slide number is, 28. Zero period exporter would have done what agreement? Sell. Let's suppose 45.80. It depends upon, he comes after 1 month and requests bank. Original agreement was for 3 months. Original was for 3 months, and after 1 month he comes to the bank and request bank settle out here only. Means I wanted to sell you and you wanted to buy, do the agreement today only. It all depends on bank whether bank will accept or not. But since you have to do the question exam, acceptance would be 100%. Means otherwise question will not frame up. Your agreement was to sell, bank will do what? Buy. Bank will buy at what rate? Agreed rate. What was the agreed rate here? 45.80. Now actually understand from my perspective. You are customer. You were supposed to receive dollar after how many months originally? 3 months. You said you will do what? Sell to me. You know what I did? I also did the agreement to sell in the interbank market, and I would have made some margin out of it. Now you came after 1 month. From your side transaction is over, so you can happily go back home. From my side there is a problem. My agreement is standing still at 2 months after. Understand the problem first. You came to me, your agreement I can do, it's okay. You came to me and I can buy, but if I buy from you after 1 month, what will I do with it? I have nothing to be done. So what bank does is, bank says okay, I'll buy from you, and bank will sell at spot rate, and bank tells you very clearly, if there is an outflow I'll charge interest on it. If there is inflow I could have given you interest also, that because if I am doing after the mutual agreement. So basically there was no objective of buying, it's only you requested, I accepted, you sold, I bought, and I sold in the interbank market at this rate. So this is perfectly done. Your transaction is over, you can sleep easily. I am not able to sleep. Reason being, there was commitment of 3 months here, which when you did the agreement with me, I also did the agreement after 3 months in what? Interbank market. Now I know, since you have already come to me after how many months? 1 month. You will never come back after 2 months more. So how will I fulfill my commitment here? I am saying how I will fulfill my commitment here. Now before I create a swap, just logically let's try to make understanding. In exam I am saying, illogically I'll tell you how to remember. Logically let's try to make. You will do what? Sell to me. I would do what? You will sell to me. I would have done what? Sell. That means, can I say something? I would have bought from customer and I would have sold in which market? Interbank market. Is that fine? Now since you came after 1 month, I bought from you, I cannot carry this risk, so I sold it off. That's fine. This transaction is over. Now this means after 3 months you will not come. I have what transaction pending here? Sold. That means what type of transaction I should create at 1 month for 2 months, so that I have availability of dollar to take care of this liability. Buy transaction. I hope you are getting my point. So to fulfill this transaction, I will have to do what? Bank buys. Logically, if I do what? It's basically bank sells, this sell, and bank buys. Bank sells and bank buys. Logically, if I try. But if you want to understand philosophically why it was done, was because originally customer would come here, I would sell, life was systematically going. But since you already came, you will not come here. My selling commitment is still standing here. Since selling commitment is standing, how would I fulfill my commitment after 2 months? From where 2 months? From here. That means standing in 1 month, for the another 2 months I will create such contract, so that the agreement of selling which I have done, I have availability of what? Dollar. So I'll do the agreement of buy. This buy comes because of this reason. Understanding wise, if I try to create this, bank sells, this sell will be first part of this transaction and bank buys. And if I do second way of logic is, you came to me after 1 month, you came to me after 1 month, I bought from you. I had two possibilities. Either I carry forward this risk, or if I carry forward, then there was no challenge. I'll carry forward, and after 2 months when my commitment comes, I can pay it off. but since I cannot carry forward this risk, so I'll do what? I'll sell and buy. So this buy can be read from this, or how to fulfill this commitment because of this reason. I hope you're getting my point. In exam, simply remember is what I would have told you, because the logics, it's okay. During classes we can discuss. You can also say yes, we are understanding, but in exam the pressure cooker is at some different level. In that case, only remember is customer went to the bank, bank buys, bank sells, automatically bank buys. This is the best way to remember in exam. Logically it's okay, because if you were doing a fresh classes, you come early in the morning, sitting here, no logic, without logic, what do? Nothing. And by the time 3 months happen, the course gets over, by the time exam comes, how to score marks? How did we get marks? Regular batch becomes a fast track becomes ultra fast track becomes a marathon. So that is exactly what happened. Logic is this. Otherwise, simply remember this first transaction you will be able to create, whether it's a cancellation. In cancellation also what we did was bank buy, bank sell and buy. In this case also bank is buying from you, bank is selling, bank sells. This is exactly same. And bank why buys 2 months forward? Because the liability is standing where? 2 months forward. Can we look at the example now? Let me look at this. Then we'll take up the importer case. Importer I'll ask you to make on your own. In fact, exactly same way. Exporter. Let's make it. Exporter is expected to receive $10,000 after how many months? 3 months. He enters into forward contract with the bank at 45.80. Now what kind of agreement he would have done? Sell. Agreement to sell at 45. And bank would also have done the agreement in term to sell. After a month, he requests for early delivery. Exchange rates are these, 2 months forward rate are these. Now bank will buy at what rate? 45. Try to put the rates here. Just try from your side. Do not flip over the slide. Put the rates on this chart only, please. Do not flip over the slides. First rate should be very clear to you. 45.80. Bank is buying. And then bank would do what? Selling. Now please do not get confused. Bank is not selling to customer. Bank is selling in the interbank. You sell, I buy, bid rate. I sell, some other bank would be buying. Again which rate? Bid rate. And which one? 45.75. We can assume interest rate of 15% for the purpose of outflow. Outflow comes 0.05. Total outflow would be 10,000 into what? 10,000 into 0.05 and 500 into 15 by 100. How many months? Very small number would come 12 point. Now second is swap. Bank sells 45.75 and bank will do the agreement to buy 2 months forward, because he has to fulfill this commitment. In which market? Buying, you asking ask rate, I am asking also ask rate, but I am asking which market? Bank ask rate 45 point. Total swap loss would be 10,000. 2 point. How much? 1,000. Now how much will go to the customer is, sir? Bank will buy $10,000 and pay you how much? 10,000 into 45.80 minus 12.5 minus what? 2,000. Now you can check. Now you can check the answer on the next slide. Want to practice one more? Should I give you as a testing exercise? Only the numbers I need from you. Should I show you? Examination question. Look up. You will not have that question. I want you to try and tell me the numbers. $72. Is January 1, 2019, Global Limited exporter entered into forward contract with BBC Bank to sell $2 lakh on 31st March 2019 at 71.50. This was the agreement done by the customer with the bank to sell. However, due to the request of importer, Global Limited received the amount of 28. So it's basically Global Limited has received earlier now, and how many days earlier? 31 days. 28th Feb is 31 days here. Global Limited requested the bank to take the delivery of remittance on 2nd March. It's basically T+2 he's saying, but you assume is 28th Feb only, which is coming. Interbank rate settlement is happening on this date. Spot rate, 1 month premium is given. If the bank agrees to take early delivery, then what will be the net inflow to the Global Limited, assuming prime lending rate is 15, assume 365 days. So basically the 28th, if I stand and I agree, bank will buy from customer. Bank will buy from customer at agreed rate. What was the agreed rate? 71.50. Bank will sell at what rate? Spot rate. Very good. Bank selling in which market? Interbank. 71.20. Do not make a mistake. Bank is not selling to customer. If he was selling to customer, it was 71.25. Interbank rate, bank is selling to some other bank. It's 71.20. So your outflow comes is 0.30. 0.30 into 2 lakh 60,000, and 28th Feb is settlement happening, though the money would come on 2nd, but 31st, 28th we assume it's happening. So into 60,000 came total amount. 60,000 into 15 percentage for 31 days. This comes my first answer. This comes my first answer, interest on outlay. Second part I'll show you once you've done this. He bought from the customer, sold in the interbank market, outflow 60,000, 31 days, interest 764. Now second part you can look at. Second part is swap. and don't get confused now. This sell will become first part, sell buy swap, and before that you will have to calculate what? Forward rates at the premiums. Calculate that please. Calculate that quickly. Will be sell at spot rate, buy at 1 month forward. Buying at 1 month forward would be 71 point, selling at 71 point. How much loss? 0.15. 0.15. I have done the swap transaction. I have a swap transactions. Bank sell dollar at spot rate, bank buy 1 month forward 71.35. Swap loss on $1 0.15, spent 30,000. Then you have what? 1 month. This is basically calculation of the rates. And then total inflow outflow you can calculate. It's an exporter, so you'll get inflow minus interest minus what? Done. This is my net answer. Net inflow to the exporter. Net inflow to the exporter, that is Global Limited. Bank buys $2 lakh from Global Limited at the rate what? 71.5. Interest on outlay 764. Swap loss swap loss Now once you've done this, let's create logically the importer. Importer done 3 months contract. Assume yourself to be importer. You've done a 3 months contract. What kind of a contract you would have done? Buy. And I would have done what? Sell. You come 1 month, request for early settlement. You will buy. I will do what? Sell. I will sell. But the moment I sell, from where do I get? I will have to buy from the interbank market. That will get cancelled. Now think of a situation after 3 months. After 3 months, what would have happened if things would have gone nicely well? Then in that scenario, think of a scenario of an importer. You would have done the agreement to buy from me. I would have done the agreement to buy in the interbank market. You request for early delivery settlement, whatever happens. So you will buy from me. I will do what? Sell. And since I sell, I have to buy from the which market? Interbank market. Bank buys. And Now ideally not applying any brain, then bank buys what? Bank buys, and then bank what? Sells of 2 months. That's a swap. How do logically that finds out? Is exactly is, ideally you should have come to me after how many months? 3 months. And after 3 months you would have bought from me, I would have bought from someone else. Now since your contract is settled at 1 month, my buying contract is still outstanding after what? 2 months from here. So I have to create a 2 months contract of what? Sell. Understand the reasoning please. Second one. Understand what is happening here. This why I am doing this part here. This part is done because originally you would come to me 3 months. You will buy from me. I will buy from someone else. Since after 1 month things are settled out. Now I will buy after another 2 months which will come to me. What will I do with that? So for that I have to create agreement at 1 month only that I will do what? Sell at 2 months forward. So when I buy this, earlier you were coming, I was selling to you. Now you are not coming. I will buy and I will sell at what rate? This. Sell 2 months forward. Or logically if I say you came to me at a 1 month, I'll do what? Bank sells to you by buying in the what rate? Your contract is done, and buying and selling creates a swap. Logically if I say whatever I'll be buying after 2 months from here. Now earlier you were coming, I was selling to you. Now since you are not coming, so after 1 month I have created this kind of a second part here. This part is created to take care of this liability. This logic would be difficult. I am saying again in exam to remember only this first part. In the first part, whatever comes the second becomes the first transaction. If it's a bank buys, bank sells will be 2 months forward. In the exporter case also, it was the selling and buying. It is buying and selling. You cannot remember 100%. I am saying if you try without, if you remember the first part here, this part, then no matter which type of swap, whether it was a cancellation after due date, whether it's an exporter case, whether it's an importer case, you remember everything. Logically I have told you for this purpose actually I create this swap, and similarly to fulfill my commitment in the exporter I create my swap. But illogically if I do whatever comes second here, you make this as a first swap transaction accordingly. Can I try out question now? Let me try. We did question number what? 72 as of now. Let's try 73. Not let me try, you try 7. Quickly try out. And if there is any inflow, interest would be given to the customer. And try the straightforward way. It's an importer will buy, customer will sell. Buying in the market, that's sell buy, that buy and then sell 2 months or 1 month, whatever the period is. Try in this system, you will be able to arrive at answer. 73rd. These questions have come recently also. I've taken only one of them. On 19 January, Bank A entered into forward contract with the customer for a forward sale of US dollar 7,000. Delivery 20 March 40.67. On the same date, covered position by buying forward from the market due on 19 March at 46.4655. It means customer will buy from you at 46.67 and you will buy at what? 46.555. And on 19th Feb, 1 month before, customer approaches bank request for early delivery. Rates prevailing in the interbank markets are these. Assume a 1 month date only. Interest on outflow is 16, interest on inflow is 12, flat charges are 100. Amount to be recovered from the customer. Which date are we standing, by the way? 19th Feb. Importer customer. Importer will buy and bank will do what? Bank sells to customer to, wordings are very clear, customer at what rate? Agreed rate. What was the agreed rate? 46.67. Now how will bank sell? Bank will not have anything because originally it should have come on March. But bank will do what? Bank buy from where? Interbank market. At what rate? What rate of 19 March? Bank will buy at what, sir? Bank buying 46.58. 46.5800. This inflow 0.09. Interest on inflow would be passed to the customer. 0.09 into what? 7,000 into what? 12% for 1 month. 6 point be given. Now for swap, simply remember buy, this becomes first part and automatically what? Sell 46.3550. If you have to remember why he is selling, he is taking a contract of selling forward because whatever he will receive after 1 month, earlier you were coming, now you are not coming, to whom will sell? So that selling contract, sell 1 month forward 46.55. Sir, why he is forward? Because he will sell taken contract, because whatever will come after this, what was coming at 46.655, that will come anyhow. When that will come, this agreement will get cancelled off. Any swap, how much you get swap loss? 1575. 73. My first part answer was interest on bank will sell dollar customer at agreed rate. Bank will buy interbank market 0.09. 6 point. This we calculated all of us. Second part swap is this. Second part sell becomes first part here. Bank will sell dollar at spot rate, which was the second transaction in the first one, and bank will sell buy at dollar at this rate and sell 1 month forward. This selling will get compensated from what will come after 1 month from here automatically. 1.5. And net flow you can show is customer will buy and then add swap loss, and there were some charges, flat charges 100 rupees also, that you add back, and minus what? The interest. Done? It answered. Amount to be recovered. from customer. Bank will sell $7,000 to the customer at 46.67. Add swap loss, flat charges, less into net amount to be. Done. This was modification of the forward contracts. Next question what we have, this was 73 na 74th. Some questions are based on the practical oriented rates. 74th is one of them. When I go to 74th, let's go to 74th. 74th is not tough if you read. '74th is not tough when you read from here. The only problem is how to read the quotation. Sometimes you'll have the quotations way in which you will have GBP yen. It's basically 1 GBP is equal to yen 148, because in 1 yen GBP cannot come 148. GBP dollar, 1 GBP is equal to dollar. The problem, these are actually practical and the correct way of writing rates. Whatever we were doing were all theoretical academic style. There's two way of writing. When I write this way rupee by dollar, you write this way rupee by dollar. Academic style is $1 is equal to, practical style is 1 rupee is equal to dollar. Now what would you do in the exam if it comes? The best way to remember for the exam perspective is, simplest way to remember for the exam perspective is, you can easily identify, I think yesterday's class I would have told you, in 1 GBP more euro, more 1 euro more dollar, $1 more rupee, and 1 rupee more yen. So if these common currencies are there, you can identify. In case parity, either rupee relationship would be given. I think I would have given you question number 40 or 41. Let me go back and I might have given you question number, I think 41 I have given you now. If you go to the 41 question, that's also based on, that question was not very strange or tough question. It's only given as, if you look at, it's given relationship as dollar INR. Now if you look at, in 1 INR 48 rupees cannot come. So this is given a practical style. It means if rupee relationship is given, 1 rupee is equal to $1 is equal to rupee 48.3. That means you are reading this as commodity and this as a price. So subsequently you will read 1 GBP is equal to rupee, 1 GBP is equal to dollar. If rupee is given, you can easily identify whether rupee by dollar is reading from the academic style point of view or a practical style point of view, and rest of the relationship you can find. So this was rupee given. In question number 74, what we were doing just now, if you go to 74, rupee relationship was not there, but still relationship of a yen and pound was there, and we know in 1 yen 148 pound cannot come. 148 pounds cannot come. So it's also given what? Practical style. If sir any currency other than these is given or we are not able to identify, then simply assume academic style and do the, because when you move to the practical style, actually these are the rates to be. Now do not make such criteria. If GBP, JPY is given, it's practical. If symbol is given, it's academic. Is it not so? It depends on the examiner, and somehow there's a conflict between them. So according rates are given. 5 common currencies, you know the relationship, you can easily write. If that relationship you cannot identify, whatever you've been doing, you do the same way, exactly same way. Whatever that means, sir, if rupee by dollar is given, if I can identify its practical style, I'll read 1 rupee dollar, 1 rupee, etc. In case I cannot identify anything, I'll read $1 is equal to rupee, academic style. Now let me read this question out. It's a simple question. Maybe it can come back again. Just language wise it was slightly technical maybe. It says, the treasury desk of a global bank incorporated in UK wants to invest GBP 200 million on 1st January for a period of 6 months. That means UK want to invest 200 million on for a period of 6 months. Equity trading desk in Japan want to invest the entire GBP in high dividend yielding Japanese security that would earn dividend income of this. Dividend are declared and paid on 29 June. Post dividend securities are traded at 2% discount. The desk also plans to earn JP by 10 million on stock borrowing and lending activity. That means they'll borrow and lend, and accordingly they'll earn some income of it. The securities are to be sold on 29th with T+1 settlement, and money would come back at the end of June and they will revert back to the London. Objective is 200 million, take it to Japan, 0 period, invest in Japan, at the end of June, come back to what? UK. That means in 0 period, you'll apply spot rate, convert in Japanese currency, then whatever Japanese currency at the end, reconvert back at the end to normal. Second option of investment is fixed income desk of US proposed to invest the amount in government securities. G-SECs provide a return of what? 5%. So one is from the London pound, go to Japan, earn in Japan and come back pound. Second is go to US spot rate, earn in the US and come back at forward rate. Just check the answer. I'll show you my answer. Check the answer. I'll show you my answer. Answer is given in the book itself. I'll show you one more way of doing. Basically, I have two options. If I give you, maybe you would be given same answer. You can check from the book also. If you earn from equity trading in Japan, then this 148 spot rate I apply, this will become Japanese yen 29,600 million plus dividend plus stock lending, and value at the end becomes is 98%. So basically you have three values here: 1182 10 million plus 29,008, because he says after the dividend your value will fall down, and you will have at the end what available? 30,200 million. Convert back at what rate? 30th June. So when you convert back at 30th June, in hand you return back in GBP 1.33. Similar exercise try for the US. Similar exercise try for the US, please. Similar exercise tries for the second one. US, if I try fixed income desk of the US, when you go in the fixed income desk, when you go, spot rate available GBP, it will be dollar how much? 256 million. Earn interest at the rate of what? 5%. It will be 262.4, and then come back to what? Pound, and I think answer comes exactly same, 1.33. So whether you go to the Japan and come back, it's 1.33, and whether you go where? US, it's 1.33, because you'll get interest, then total amount. This total amount when converted back, left hand side confirmed currency, left to right I multiply, I get 201.33, and 201.33 and 200 million was investment, my income is 1.33. So my decision would be actually based on the equivalent amount of gain in both the options is same, hence the bank can go for any of the option. However, from the risk perspective, if I try to look at the investment in fixed income desk, is US is more better, because these are the safest of the instrument. Why should I go and invest in equity when I am getting same return in the that's US securities, fixed return? So the fixed income is better off because they fluctuate less. rather than the equity desk. So why would someone invest in the equity market if they start getting the higher return in which market? This was not a very tough question, it was a general question just to explain you the concept of the academic practical rates. Now one very off track question came in the exam, not there in your books, your notes. I'll do it from my side, and the way of doing is very different way. Only once it has come, and person could have been from the practical side, could have known who created this. Let me first question number what we were doing 70 75 only. January 2021. Now look at this part here, 75th. I'll just read out with you. Some new terms will come. I'll explain you while reading this question only. Messrs. Sky Products Limited, Mumbai, an exporter of seafoods, exporter, has submitted 60-day bill for 5 lakh drawn under the irrevocable letter of credit for negotiation. The company had desired to keep 50% of the bill amount in EEFC account. This is a new term for you. EEFC account is basically exchange earners currency account, in which he'll keep some amount so that it does not take a time for him. For example, foreign currency can be utilized as and when desired. Otherwise, I go and convert, borrow, etc. Whatever I do, some amount I'll keep in the foreign currency account only, and whenever I want I can use. So basically half would be kept, half would be transaction would be on 2,50,000. The rates for rupee USD and euro USD. So I can make out it is given academic style, because rupee by dollar, $1 is equal to rupee this much, and this will be read as what? 1 euro is equal to USD 1.0775 and 1.800. Prima facie the rate looks slightly odd, because 1.0775 and 1.8, there is a huge gap between the bid and the ask rate, but you should not have any trouble with that. Then transit period 20 days, new word for you again. Interest on post shipment credit is 8%. Exchange margin 0.1, assume 365 days. You are required to calculate exchange rate to be quoted company. Basically this question is based on a parameter in which we have to decide the time period. He said was how many months? It's not 60 plus 20, actually after shipment time taken, so time period will be approximately 80 days. Now 80 days fall where? 80 days fall where? After 2 months and 3 months. We need what? 80 days rate, na? We need rate between what and what? Between what and what? Rupee and euro. Rupee and euro, na? Ask for a bid rate. Ask for a bid rate, because exporter, we need a bid rate. And for how many days? It's 80 days. It's not 60. 20 days transit period also will be taken into account. It's 80 days. So basically between this and this rate it will fall here. This question was slightly different way of doing it, using my spot rate and 2 months forward rate. 2 months swap points are given. Can I calculate the forward rate? Yes. Similarly, using the, assuming these are correct only, because you have no choice, using this and this, can you calculate the rate? Yes. Now actually before I move forward to do the question or show you the answer, In rupee and dollar, rate is given what? $1 is equal to premium points or discount point? Premium. So can I say dollar is stronger against rupee? Yes. Second case, it is given €1 is equal to dollar. If you look at again what we have, prima facie premium points. So which currency is stronger? Euro is stronger against dollar. Is stronger against dollar. Both ways, no? Now we have to find relationship of rupee and euro. If dollar is stronger against rupee and euro is increasing against dollar, then automatically euro would be increasing against what? Rupee. I hope there is no challenge on that part. It will be this way. That means euro would be stronger. Now let me put out what does it mean in normal language. If I say let's equal to rupee 45 spot rate, €1 is equal to rupees 48 2 months, €1 is 50. This is a stronger or a weaker? Stronger, no? This is exactly, rates are not same. I'm just assuming if today rate is 45, if it becomes 48 and 50, so basically euro is strengthening against what? Rupee. Now in this type of a question, what has to be done is bank will round off to that particular month. Bank will round off to that particular month which will benefit the bank. It is not 80 days you have to calculate. Understand how it has to be done. EFC account and this comes out. The rounding off would be done which benefits bank. Which part benefits bank here, sir? It's an exporter. You will sell. I will do what? Buy. If I buy €1 at 48, I'll give you how much rupees? 48. 48 is not the rate I've just assumed from my side. If I do 48, I think I would have taken that numbers also. Let me show. Yes, I have taken those numbers also. So let's suppose if I have taken 2 month forward rate, €1 is 75 and €1 is 80. I've just taken rough numbers here. So rounding off would be done is to 2 months. You know why 2 months? Whatever situation will benefit bank will do that month rounding off. That is exactly this question based on. If it is 75 and 70, 3 months rounding off would have come 70. That would only happen when euro was weakening against rupee. That would only happen. So in that case, bank would round off to what? 3 months. So the situation here is prima facie I can make out from here. The dollar is strengthening against rupee, euro is strengthening against dollar. It automatically means euro is strengthening against what? Rupee. That means the more the bank delays, the benefit goes to the customer. There is no free lunch in this world. No matter what we say, bank is helping and etc. Bank will do rounding off whatever benefits bank. So bank will do rounding off to which month? 2 months. Hence we'll find what rates are? 2 months rate. We'll find a 2 months rate. That means what I'll do is 67.800, 67.8100 and they are given 10-11 paisa. So I'll find out the rate. So when I'm doing rounding off, so I have written off that same theory only here. When we do rounding off, when we do rounding off, since it's a case of exporter, we need to find rupee per euro bid rate. It was given 67.8. Rounding off would be done at 2 months because the more I delay, the more will go to in the hands of what? Customer. So this will be, actually remember also one more part which was slightly problematic here was basically this part was problematic. It's 10 and 11 paisa. So directly you can do 21 and 22 paisa. This you will take. And when you take 0.40 and 0.45, these are in cents. 0.40 and 0.45, these are in cents. So it will come 0.0040 and 0.0045. So accordingly you have to take care of it. I have written here when I write this way, the company is negotiating bill of exchange. It want to keep 50%. Therefore, for 2,50,000 only will do it. And from the data given in question about the exchange rate, it is clearly visible that euro will be greater than dollar. Euro is gaining or is at a premium. Dollar will also trade at what? premium against rupee, therefore euro would be gaining against what? Rupee. And we can easily make out euro will be trading at a premium against rupee. From the question we could make out. This you don't have to write in the exam. I just written for the purpose of understanding. So the month would be rounded off to lower month, that is 2 months. And since 80 days falls between 2 and 3 months, we'll round off to 2 months. Lower amount would come in the hands of the exporter. So more, if it would have delayed, the higher amount would have come. So when we do basically rough work, I have done it here. The rough work was basically, if dollar is increasing, euro is increasing against the dollar, ultimately we have the if we more delay, bank, the exporter would receive more. Bank will do such rounding off in which exporter receives lesser, and it is favorable position for the bank. It's a favorable position for the bank. And then he asked us to calculate, once we know 2 months rate, we have to calculate. You add the swap points, you get relationship of rupee and dollar. In euro, sir, you have written y.00, it was given 0.40 cents. In paisa, it was given 20 and 21 paisa. So accordingly, it has been done. You get rupee, the relationship of dollar and euro. You need relationship between what, sir? It was case of what? Exporter. Since it was a case of exporter, we need to find rupee per euro, which rate? Bid rate. Rupee on the top and euro on the bottom. So rupee on the top and euro on the bottom. When we multiply these two rates, we get this. Then adjust for margin, and this exchange rate will come. That will come. That's basically about the rate. Once you get that rate, then he asked that what is the inflow, second part, and then the interest. Only one part which I was not comfortable with the institute part was they have shown the gross inflow. So when you're writing answer in the exam, I'll show you mine and theirs also. This part is okay, everything would be same. It's only rounding off to be done to that month, which will give lesser amount to the exporter. That's it. This was there. And EFC account is nothing but the currency would be kept. It will be as and when he'll require, they can take out from there. Now what I have done is I have shown the amount to be received as this. Your institute has shown this. So my advice would be, I'll show you their answer also. Advice would be show this amount and show as a gross. This is net of interest, because you'll have to pay the interest charges also. Interest charges are shown separately here, but when you are showing the amount to be received, cash inflow to the company, actually they used a point. The point they used was cash inflow to the company. Now cash inflow to the company, if you're writing the answer would be coming same, rounding of problem can come. It will be 183,69,825 depending on slightly rounding off. You write here it is excluding interest, and excluding means interest has not been subtracted, and interest is shown separately. There is no problem, interest is okay, interest shown separately okay. What I showed the answer was, my answer is slightly rounding off here because I get here 2 of 3. They were getting 3. Maybe while doing in the class we might have got last digit as a 3, I think. So this was basically 2 I am getting, and they were getting 3. So I have shown this amount net of interest. If you want to show gross amount, then leave your answer at first part. That was there. EFC account, by chance, because it came in January 21, there could second time it can come. You do not have to build up any story. What has to be done? Simply just look at prima facie that what is strengthening. Since euro was strengthening against rupee, we automatically do the rounding off in such a way so the lesser amount comes in the hand of the exporter. That's exactly the question. Otherwise, question was not tough. When you solve this, this is a very small part. Normal question. It's the smallest of the question you can have, and they directly write the answer here. How to calculate? You only know how do they calculate. Exactly, I've copy pasted from there. It's 80 days. Basically, a transit time and this 60 days, both you have to add. It's kind of a bills of exchange. Some principle there added, and then rest of the principles added. Rounding off adjustment was important in this. That was an off track. And then I think only 1 or 2 would be left. You have the answers. You can go back. This was off part the examination. Which question is there? 105 you have? That I took, I think maybe practical rates, or what was? Do you have the answer in the book notes? 104 you have. 104 also you have. 104 is actually cross currency plus something. You can try at home. Answer is right. Answer is right. Try at home. And 105 was practical rates plus swap points. Actually. 105 I have given you. You can try at home. It was actually practical rates are given. So how do we identify? The way of identifying is in 1 GBP more dollars will come. So it's a practical rates plus the swap points. Maybe for that reason I would have taken. In fact, 42 or 43 is also same. There could be possibility some questions would come in that part. Answer is given, I think. Yes, answer will be able to identify. In exam, be careful please. Practical rate comes, I'm saying it again. If you have 5 common currencies able to identify GBP, then euro, dollar, rupee and yen. Any other you cannot identify. Rupee is given, then automatically you can identify. A rest relationship can be there. But I presume they should be more careful while setting a paper. That's it. That's fine. Let's wind up the Forex here. Take care and bye bye. Take care.